Today, we are going to talk about short-term rental financing and vacation home loans. This is one of the huge questions that a lot of our investor clients will reach out to us for, asking about how do I get started? What type of loan options are there for me? So I want to cover some of this info with you here today. Those of you that may be tuning into our channel for the first time, I am DaveDavis. I am with Barrett Financial and also eXp Realty. Barrett Financial, we are a nationwide lender. We have probably 50 plus different banks that we work with. So whether it's a Fannie Freddie type loan, a jumbo loan, DSCR loans, bank statement loans, 1099 loans, cash flow loans, whatever it may be, we have a product for you. So feel free to reach out. But today we are going to focus on 3 different types of loans that we basically use for our vacation properties and investment properties. And those are going to be second home loans, investment loans, and DSCR loans. So let's just jump right into it. Second home loans. This is one of my favorite products ever. This allows us to buy vacation rental properties with very little amount down. So these are 10% down loans, whereas most investment properties are going to require you to have at least 15 or 20, or some of them are even 25% down for your down payment. The second home loan allows you to use 10% down and basically pick up a second home like that you're going to use for, again, maybe you're going to snowbird 3 months a year. Maybe you want to go down for spring break or summer break or Christmas, New Year's time, whatever it may be. This is a home that you're going to use personally for you and your family. And then the times that you're not using it, you're free to go ahead and rent it out. You can do Airbnb, you can do rental income on this property. So the cool thing about these is, again, they're 10% down only. They are Fannie Freddie conventional loans. So we do have certain debt to income limits that we need to watch out for. If we're going to be in a conforming loan limit, which in 2023 is now $726,200. So if we're going to stay with a loan amount under this, not purchase price, but loan amount under this, we can go up to 50% of our debt to income ratio. So that means whatever my maximum monthly income is, I'm going to take that times 50% and then back out all of my mortgage expenses, car payments, credit cards, student loan payments, and that will leave me with what my leftover debt to income ratio is. And as long as that plus the new loan for the vacation home is under 50%, you will be qualified for the loan. If we want to move up to jumbo loans, those are a little bit tighter. Typically, we're going to be at 45% max debt to income ratio for jumbo loans. And again, that would be a loan that's $726,200 or more. One of the key caveats for these second home loans is, again, we are purchasing this as a second home loan. So we are telling the bank that we are going to be using this property at least 14 days a year for personal use. Okay. This 14 days is kind of a key metric because when we do, and again, this is something to talk to accountants about, but on your tax returns, you are allowed 14 personal business days of use on property. If we go over that 14 days, it doesn't become a rental property. It becomes basically a personal property. So you might lose some tax advantages if you are going to do rental, if you're going to do like Airbnb, Verbo, short-term rentals on these properties. Watch out for that 14-day, but you are telling the bank with these second homes, you are going to use it at least 14 days a year. These are going to show up in your personal credit. It's going to be closed in your personal name. Sometimes, depending on the bank and depending on the lender, you can quick claim this to an LLC if you're the majority owner of the LLC. So if you are going to use this as an Airbnb or Verbo property and you want to put in an LLC just for more asset protection, you can do that. Majority of the time, you do need to talk to the lender and make sure they're aware of what your intentions are. This isn't something where we're going to buy this property, never use it, just run it as a short-term rental property and cash flow. It's not meant for that. It's meant for using it as a personal property. But this is a great option for, like I said, vacation homes, second homes. If you're going to snowbird, perfect option. Now, if you're looking more towards just strictly investment property, there is a 15% down investment loan. This is one of the coolest products that's out there because, again, instead of putting 20% down, we can go ahead and put 15% down as an investment loan. We can also use 75% of the projected rental income to offset the debt to income ratio. So going back to, if we're doing a conforming loan limit, say we have a mortgage of $400,000, right? And whatever that monthly payment is, we can use 75% of the projected rental income to offset that debt to income ratio. So for example, if the new mortgage payment was going to put us at a 56% debt ratio, we're over the 50% debt limit, we can have what's called 1007, which basically the appraiser is going to go out and the appraiser is going to say, hey, I think this property as a rental would bring in $2,000 a month. Right, we could use 75% of that to offset the new mortgage payment. So $2,000, 75% is going to be $1,500. So $1,500 of what our new mortgage payment can be wiped away with that projected rental income. So it allows us to reach actually a higher debt to income ratio than we could by using this projected rental income. Again, one of the huge benefits of this is we're only putting 15% down rather than 20%. Now, the negative is that you will have mortgage insurance on the loan. Because we're not at 20% on the loan, there will be some mortgage insurance. Typically, it's not that expensive, so it's not that big of a deal. But it is a great option for those of you that are looking to pick up an investment property, but you might be tight on your debt to income and not sure if you can qualify. Well, we can qualify using this projected rental income. Again, we can do the same thing with 20% down. We're still going to be using the 75% of the projected rental income. The better thing on this is there's no mortgage insurance on the loan. So we're not going to have an extra monthly cost for mortgage insurance, and the rates and loan costs typically are going to be better at 20% down rather than 15% down. So it might make a bigger difference in that monthly payment, and especially if we're looking for cash flow on a property, it might make more sense to put the extra 5% down to not have MI and to have a lower interest rate or lower loan cost on the investment loan. Now, some of you may be self-employed. Some of you may get creative on tax returns and not be able to show enough debt to income that even with this projected rental income, we still can't qualify for a loan with DTI. This is the perfect case or perfect example for using DSCR loans. So again, these are debt servicing coverage ratio loans, which basically means that as long as the debt that we have on the loan is covered by the rental income, we can qualify to get this loan. So these are typically commercial loan products. They don't use personal debt to income. It's only based on rental income. Depending on the lender that we use, they're either going to use the 1007, which is that when the appraiser goes out and says, hey, I think this property will rent for X amount of dollars per month. Or in some lenders, they'll let us use short-term rental income, which might be like AirDNA data, where the property might be in one of the huge vacation rental markets. And they may say, hey, based off of where we're at in Gulf Shores, maybe in Gulf Shores, this property bring in $60,000 a year in short-term rental income. So that's the income we're going to use to offset the new mortgage payment. And how this works is basically if we have, say we have $1,000 a month mortgage payment, well, the rental income needs to be at least $1,000, right? We need at least a 1-to-1 ratio. Some lenders like to see a 1.2 ratio or even a 1.25% ratio, meaning we would need $1,250 of rental income for every $1,000 of mortgage expense, right? So we're showing positive cash flow on the property. And as long as that property can cover its debts, they will approve that loan for you. Typically, the rates for these are going to be based off your credit score and the property type. So single-family houses will have a better interest rate than condos will. Warrantable condos will have a better interest rate than non-warrantable condos. And again, that may dictate the amount that you have to put down as well. Typically, DSCR loans, you're going to be putting 20% down. Sometimes if you get a non-warrantable condo, you might be required to put 25% down. And if you get properties that are condotels, where there's there's property management on site, you could kind of walk in and rent a place, but individual people own it, that's considered a condotel unit. Some of those you're going to need at least 25, maybe even 30%. A lot of lenders don't like to do on those too much. One of the other big benefits with DSCR loans, though, is that some of these lenders will let you close in an LLC. So instead of closing in your personal name, you can just go ahead and close right in the LLC. So you don't need to worry about doing a quick claim after the close. And some of these will not show up as personal debt. So some of these will show up as business debt only, meaning if you're still going to want to purchase, maybe you want to purchase a personal house next year, but you want your investment property this year, well, you can close an LLC. That debt's going to show up on the LLC. So when a new lender goes to run your credit for all of your debts, that mortgage will not show up as a personal debt because it's a business debt, because again, this is a commercial product line. Now, not all DSCR lenders will do that. Some DSCR loans are going to show up on your personal credit. So make sure that you talk to whoever's doing your loan before that, preferably me, and I can guide you through, yes, this lender will be on your personal credit, or no, this lender will not show up on your personal credit. So those are kind of the three loans in a nutshell: 10% down second home loans, investment loans, and our DSCR loans. If you have any questions at all on any of these products, feel free to reach out to me by email, text, phone call. I'm always happy to run through these options and explore your situation with you.